Amazon has just made one of its boldest financial moves in years. The company is raising approximately $25 billion through a new bond offering, even though it already generates tens of billions of dollars in operating cash flow each year. At first glance, that doesn't seem to make much sense. Why would one of the world's strongest companies borrow even more money? The answer has very little to do with liquidity, and almost everything to do with artificial intelligence. Amazon is investing at an unprecedented pace to expand AWS data centers, AI infrastructure, and cloud capacity. While some investors worry that soaring capital expenditures will pressure earnings in the near term, others believe these investments could strengthen Amazon's competitive advantage for years to come. So the real question isn't whether Amazon is spending too much. The real question is whether Wall Street is still underestimating the long-term value of AWS. If you've followed Amazon for years, you know the company has never been afraid to invest aggressively. But what happened over the past 2 weeks suggests that Amazon is entering a new phase of its AI strategy. First, the company launched a roughly $25 billion bond offering, providing additional financial flexibility as capital spending continues to rise. Second, early indicators from Prime Day pointed to stronger than expected consumer demand, reinforcing the resilience of Amazon's retail ecosystem. Taken together, these developments tell a larger story. Amazon isn't slowing its investment cycle. It's accelerating it. And for long-term investors, that shift may prove far more important than the next quarterly earnings report. One question immediately stood out after Amazon announced its new bond offering. Why raise approximately $25 billion when the company already generates tens of billions of dollars in operating cash flow each year? The answer lies in capital allocation, not liquidity. For a company with Amazon's credit profile, long-term debt remains one of the lowest-cost sources of capital. Rather than depleting cash reserves, Amazon can preserve financial flexibility while continuing to invest aggressively in AI infrastructure, data centers, and next-generation cloud capacity. In other words, this isn't a company borrowing because it needs cash. It's a company using its balance sheet to invest ahead of demand. When people hear about AI investments, they often think about chatbots or large language models. But Amazon's strategy is fundamentally different. The company's largest investments are going into the infrastructure that powers AI, expanding AWS data centers, deploying advanced GPUs, upgrading networking equipment, and increasing the power capacity needed to support next-generation AI workloads. This matters because AI applications cannot scale without reliable cloud infrastructure. Whether customers build their own models or use third-party AI services, they still need computing power. And that's exactly where AWS plays one of the most critical roles in the entire AI ecosystem. Amazon isn't trying to win every AI application. It's positioning AWS to become the platform that thousands of AI applications depend on. Building AI infrastructure is expensive. The real question is whether these investments will generate attractive returns over time. For Amazon, the answer depends on one business, AWS. Although AWS contributes only a portion of Amazon's total revenue, it has historically generated a disproportionately large share of the company's operating income because cloud services carry much higher margins than retail. If enterprise demand for AI computing continues to grow, every new data center, GPU cluster, and cloud service Amazon deploys has the potential to support higher revenue and stronger operating leverage over time. In other words, today's capital spending isn't an expense in isolation. It's an investment designed to expand the future earnings power of AWS. Despite Amazon's long-term opportunities, investors remain focused on one key concern. The company is spending money faster than it can monetize many of its AI investments. Building data centers, purchasing advanced chips, and expanding cloud infrastructure require enormous upfront capital. But the revenue generated from those assets may take years to fully materialize. That timing mismatch creates uncertainty. If AI adoption accelerates as expected, today's investments could deliver attractive long-term returns. But if enterprise demand grows more slowly, Amazon could face lower free cash flow and weaker returns on capital in the near term. That's why the debate isn't about whether AI is important. It's about how quickly Amazon can turn massive investment into sustainable profits. Microsoft may have captured the headlines through its partnership with OpenAI, and Google continues to invest heavily in its Gemini ecosystem. But Amazon is competing from a different position. AWS already serves millions of developers, startups, and enterprises worldwide. More importantly, many of these customers already run their core applications on AWS, making it easier to adopt new AI services without migrating their entire technology stack. Instead of betting on a single AI model, Amazon is building a platform that gives customers flexibility to choose different models, tools, and infrastructure. That strategy may not generate the same headlines as consumer AI products, but it strengthens AWS' role as the underlying platform for enterprise AI. Today's market is heavily focused on Amazon's rising capital expenditures and the pressure they may place on near-term earnings. But that perspective may overlook a more important question. What if today's spending is creating assets that will generate cash flows for many years to come? Amazon has followed this pattern before. The company has repeatedly accepted lower short-term profitability in exchange for building long-term competitive advantages, from its fulfillment network to AWS. If AI becomes a permanent part of enterprise computing, the value of the underlying cloud infrastructure could prove far greater than the market currently expects. In that scenario, today's higher spending may be remembered not as a cost, but as the foundation of Amazon's next phase of growth. Every investment thesis has risks, and Amazon is no exception. The biggest risk isn't that AI disappears. It's that the return on Amazon's massive investments takes much longer than investors expect. If enterprise AI adoption slows, data center utilization could grow more gradually, delaying revenue growth while depreciation and operating costs continue to rise. Competition is another factor. Microsoft Azure and Google Cloud are investing aggressively, and both are determined to capture a larger share of enterprise AI spending. Finally, if Amazon cannot translate higher AI demand into stronger margins and cash flow, investors may continue to question whether today's capital spending is creating enough long-term value. Amazon's investment story is entering a new chapter. The company is spending billions of dollars today to expand the infrastructure that could power the next generation of AI. Those investments are putting pressure on near-term cash flow, but they also have the potential to strengthen AWS' competitive position for years to come. Whether this strategy ultimately succeeds won't be measured by the size of Amazon's capital expenditures. It will be measured by its ability to convert that infrastructure into sustainable revenue growth, expanding operating income, and attractive returns on invested capital. For investors, that's the metric that matters most. Because in the end, the biggest question isn't how much Amazon is spending. It's whether those billions will become the foundation of Amazon's next decade of value creation. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.